All right, let's just dive right into the financial investigation of what is arguably the most highly anticipated and controversial S-1 filing of the entire decade, the Space IPO. You know, for years we've all watched the rockets launch, we've seen the satellites deploy, and we've definitely read the swirling headlines. But now we finally have the actual numbers. In this explainer, we're going to look completely past the hype and break down the absolute reality of what this company is actually worth, specifically from the perspective of a skeptical retail investor.
So SpaceX is reportedly targeting a jaw-dropping $1.75 trillion valuation to raise about $75 billion in capital. If they actually pull this off, it would immediately make it the biggest initial public offering in the history of the stock market. It would just instantly parachute SpaceX in as the 9th largest company in the S&P 500. We're talking about a valuation that makes it worth more than Berkshire Hathaway.
And this really brilliantly illustrates the sheer scale we're talking about here. Picture this. This one space company is asking to be valued higher than Boeing, AT&T, Disney, McDonald's, American Express, and Home Depot combined. I mean, to ask the market for a valuation that completely eclipses the combined worth of literally all these legacy blue-chip profit engines, that is an incredibly bold move.
To figure out if this asking price is even somewhat grounded in reality, let's move to Section 1, Unpacking the Three Businesses.
Because it is definitely not just a rocket company. While the rockets get all the media hype, notice how Starlink is actually the heavy hitter here. When we look at their 2025 revenue projections, Starlink brings in the lion's share at $11.4 billion of their total $18.6 billion. The traditional rocket launching business, actually getting things to and from space, brings in $4 billion. And the newly merged artificial intelligence segment built around XAI brings in $3.2 billion.
But here is the massive plot twist that comes when we look at actual profitability. I mean, revenue is great, sure, but what do they actually get to keep? Well, the rocket division and the AI segment are bleeding billions in cash. They lost $657 million and $6.4 billion respectively in operating income. That basically leaves Starlink, with its incredibly impressive 39% operating margin, effectively carrying the entire company's economics on its back. Starlink is the only bright star of the bunch, generating $4.4 billion in operating income.
Because of the immense, truly cash-guzzling research and development investments required to build the Starship program, plus the vast compute infrastructure needed to train these AI models, the consolidated reality is tough. In the first 3 months of 2026, SpaceX posted $4.7 billion in revenue, but a staggering $1.9 billion loss from operations. The reality is, this is a highly capital-intensive business that is spending incredibly heavily on its future.
Which brings us to Section 2. The massive valuation gap. How does a company losing nearly $2 billion a quarter justify a $1.75 trillion price tag?
Well, spoiler alert, it absolutely doesn't. But to really understand this asking price, we have to look at what investors are projecting for the future. Let's just be wildly generous for a second and build a discounted cash flow model using some highly optimistic assumptions just to see what the business might actually be worth to us today. In 2025, they generated $6.8 billion in operating cash flow. Normally, all of this gets eaten up by capital expenditures, building the actual rockets and the satellites. But for this model, we're going to ignore those huge costs entirely. Let's pretend they get to keep 100% of that cash. They grow at an aggressive 20% per year for a full decade. We demand only a modest 10% return and assume we can sell the business for a premium 20 times multiple at the very end.
And wow, here is the sobering reality of that math. Even when we completely ignore their heaviest spending and assume absolute flawless growth for an entire decade, our wildly generous intrinsic value comes out to only $438 billion. This exposes a glaring discrepancy with their $1.75 trillion target asking price. We are looking at a valuation gap of over $1.3 trillion.
To bridge a gap that huge, SpaceX needs a masterclass in market psychology. Enter Section 3, Weaponizing Retail Investor Loyalty.
And this all starts with who exactly gets to buy the stock. In a typical IPO, the big institutional investors take the lion's share, and only about 5 to 10% is set aside for everyday retail investors like us. But SpaceX is totally flipping the script. They are setting aside an unprecedented 30% of their IPO allocation specifically for the retail crowd.
So why would they do this? Well, as these quotes reveal, this is a highly deliberate strategy to weaponize Elon Musk's cult-like following. Institutional investors are ruthless, right? They look at the spreadsheet, they see that massive valuation gap, and they just sell if the price drops. But retail fans who have tracked the company for years in private markets, they are incredibly loyal. By allocating heavily to retail diamond hands who simply refuse to sell out of an emotional attachment to the mission, SpaceX creates an artificial floor, and that prevents the early price collapses that are so typical of wildly overvalued IPOs.
But retail loyalty is literally just phase 1. Welcome to Section 4, Hacking Passive Index Funds.
Okay, let's look at how this builds. SpaceX reportedly demanded that the Nasdaq completely drop their traditional, sensible 3-month cooling-off period for index inclusion. And the Nasdaq actually agreed. They introduced a new 15-day fast-track rule just to entice giant private companies like SpaceX to list on their exchange. By shrinking this window down, SpaceX effectively bypasses the traditional post-IPO volatility period where a stock's true market price is usually discovered.
So the absolutely crucial point here is what happens on day 16. By fast-tracking straight into the Nasdaq 100 index, over 200 tracking products, like the massive QQQ ETF containing over $600 billion in global assets, are essentially forced to buy SpaceX stock. These passive funds, they do not look at S1 filings. They do not care about your discounted cash flow models or those huge operating losses. They buy strictly on autopilot. This blind, mechanical inflow of capital artificially props up the high valuation, effectively trapping the retail money that bought in on day 1.
So retail investors take the risk on day 1, and ETFs blindly support the price on day 16. Which brings us to Section 5, the ultimate control trap.
Let's take a quick look at Elon Musk's compensation package. He was granted a historic award of 1 billion performance-based restricted B shares distributed across 15 tranches. Now, to actually unlock the financial benefits of these shares, he has to hit what sound like impossible sci-fi benchmarks. I mean, he must drive the market cap up to a staggering $7.5 trillion and, amazingly, establish a permanent human colony on Mars with at least 1 million inhabitants.
From a purely financial perspective, that looks like a pretty great alignment of incentives, doesn't it? If he gets us to Mars, he gets rich. If he doesn't, he doesn't. But actually, scratch that. Here is the catch, buried deep in the fine print. While the financial payout does require actually colonizing another planet, the actual voting power of those 1 billion restricted shares was granted immediately. They have already been issued, and he can vote them today.
And this right here exposes the ultimate control trap. This structure ensures that, going into the IPO, Elon Musk controls a staggering 85.1% of the total combined voting power of the company. Think about that. When you buy a share of SpaceX, you are taking on all the financial risk of a company losing billions of dollars to build rockets, but you are completely forfeiting your say in how that money is actually spent. Basically, whatever Elon says goes. So now that we've peeled back all the layers of this $1.75 trillion mystery, from Starlink completely carrying the profitability to that glaring gap in intrinsic value, right down to the deliberate weaponization of retail loyalty and passive index funds, you finally have the full picture. The financial mechanics of this IPO are honestly just as complex as the rockets they're launching. So the only question left is what role you are going to play when this inevitably hits the market. Will you actively buy into the hype, avoid it entirely, or simply accept that your index fund is going to buy it for you anyway?